Alright, let's talk about one of my favorite ways to make extra money from the stock market: covered calls. If you've ever wondered how to put your existing stocks to work and generate a steady stream of income, this strategy might be exactly what you're looking for. Covered calls are a classic approach used by both beginners and seasoned investors to boost returns. And the best part is, you don't need to be a Wall Street pro to get started. If you own stocks and want to squeeze a little more cash out of them every month, covered calls might just be your new best friend. Instead of letting your shares just sit in your account, you can use them to earn extra money, almost like collecting rent from a property you already own. Here's the deal. A covered call is when you own at least 100 shares of a stock, and you sell a call option on those shares. This is important. You need to have at least 100 shares of the same stock to write one covered call contract because each option contract represents 100 shares. That means you're giving someone else the right, but not the obligation, to buy your stock from you at a set price, within a certain time frame. Think of it as making a deal. You agree to sell your shares at a specific price if the buyer wants them, but only until the option expires. In exchange, you get paid a premium up front. This premium is yours to keep no matter what happens with the stock price. It's like getting paid for making a promise. That's cash, right into your account no matter what happens next. Whether the stock goes up, down, or sideways, that premium is yours to keep. It's a great way to add a little cushion to your portfolio, especially if you're looking for ways to generate passive income. Let's break it down with an example so you can see exactly how this works in real life. Say you own 100 shares of company ABC and the stock is trading at $50. You like the company, but you wouldn't mind making some extra cash while you hold on to your shares. You sell one call option with a strike price of $55, and for that, you collect a premium, let's say $2 per share, so $200 total. This premium is paid to you immediately, and you can use it however you like, reinvest it, spend it, or save it for a rainy day. Now, there are a couple of things that can happen. Let's look at both scenarios so you know what to expect. If the stock stays below $55 by the option's expiration, the option expires worthless. You keep the $200 premium, and you still own your 100 shares. Nice, right? You can then repeat the process and sell another call option next month, stacking up those premiums over time. But what if the stock jumps above $55? Let's say there's great news and the price soars. Well, your shares will get called away, meaning you have to sell them at $55. But remember, you still keep the $200 premium, and you're selling for more than what you paid. You lock in a profit on your shares plus the premium, so you're still coming out ahead. Either way, you win. You either keep your shares and the premium, or you sell your shares for a profit and still keep the premium. It's a win-win situation for investors who want to generate extra income. The best part? You can repeat this process month after month, collecting premiums and boosting your income. Over time, these small amounts can really add up, especially if you're consistent and disciplined. Many investors use covered calls as a way to supplement their regular income, or even to help fund retirement. It's a flexible strategy that can fit a variety of financial goals, whether you're looking for a little extra spending money or aiming to build long-term wealth. Sure, there's a trade-off. If the stock skyrockets, your profit is capped at the strike price plus the premium. You won't participate in unlimited upside, but you're trading that for steady, predictable income. But for steady, reliable income, covered calls are hard to beat. They're especially popular with investors who want to make their portfolios work harder without taking on too much extra risk. Of course, options trading isn't risk-free. If the stock drops, you still own the shares and they could lose value. The premium you collect can help offset some losses, but it won't protect you from a big decline in the stock price. So, always choose stocks you'd be happy to hold long-term, and do your research before jumping in. Make sure you understand the company, its prospects, and the risks involved before writing covered calls. That's the basics of making money with covered calls. It's a straightforward, repeatable strategy that can help you turn your stock portfolio into a reliable income generator. If you want to turn your stocks into an income machine, this strategy is a great place to start. With a little practice and patience, you'll be well on your way to unlocking new streams of income from investments you already own. Thanks for watching, and happy investing. Remember, the more you learn, the more you can earn. So keep exploring new strategies and making your money work for you.